Okay, perfect. Again, let me first of all, thank you for the nice introduction, and also good morning to Ibu Sri and Ibu Anda, and obviously, a number of guests that unfortunately that we cannot be there in physically, but I'm actually very impressed with the number of participants in this workshop. In fact, I should congratulate IPB. Again, through the READY project, I got to know, a number of universities in Indonesia, especially IPB. So when we first started the READY project, it was a pleasant surprise to me then that IPB is already taking, a lot of initiative, many leadership role in actuarial science. For example, when we were starting this READY project, the IPB, is actually the first university that, is, offering actuarial science study program. And now, IPB also initiated this short course on actuarial mathematics. And again, showing another, another evidence of the leadership. And personally, I believe this kind of activity is very, very important, especially in Indonesia. Actuarial science is still in its infancy, and it's important that we continue to strike while it's hot, right? It's important to carry on with the momentum, and I'm hoping that this is the first of the many series to come in the foreseeable years. And again, just want to congratulate Iwenda, IPB, and this nice, excellent initiative. So back to my presentation. So again, also appreciate that honor to be here, with almost 200 participants. Okay, so this is definitely a very impressive group. I guess I was tasked to provide an overview on, actuarial mathematics, and that's what I can tell you honestly that over the last few days I've been struggling, exactly what to present. So and I hope what I've installed for all of you that you'll be happy with my presentation. So let me begin by again, I'm not sure how much you know about actuarial science or an actuary, so I think it's important for me to re-emphasize what we do as an actuary. So what can we do as well? So again, actuarial science, in my view, is a discipline that trains individual to become a risk professional, right? And typically, with a professional designation called, actuaries. And because of our skill sets, we are experts in evaluating the likelihood of future events, especially based on data, based on empirical evidence, rather than based on some crystal ball, right? And we are also expert in designing creative ways to reduce the likelihood of undesirable events. Again, in real life, we're gonna have some crisis, right? Pandemic risk is always one example. So, for example, during our day-to-day, life, there's going to be some car accidents, people will die, and so on, things like that. Okay, so one of our function is that how to design, a creative way or provide innovative solution to at least reduce those damages, right? Or reduce the probability of those events happening, right? Okay. And third, again, decreasing the impact of undesirable events that do occur. Like you say earlier, that unfortunately, as part of our life, there are many undesirable events that we will have to face, right? Okay. So then the question then is, how do we manage our risk? How do we manage those undesirable, events? And typically that most part of our work is that translate those risks or those losses into dollar value, right? So, and that's sort of a big part of what we do as an actuary. So we are the leading professional in finding ways to manage risk it takes a combination of strong analytical skill, business knowledge, and understanding of human behavior to manage today's complex risk facing our society. Again, there are a number of keywords here that we have to be very mindful. For example, it talks about a strong analytical skill, business knowledge, and understanding of human behavior, right? And again, we need to have to be very good at each of these components in order to provide, better solution, and in order to make our day-to-day life better, so that we have, some peace of mind, right? At the corporate level, we are the key players on the management team of companies that deal with risk. In fact, it is true that in many insurance companies, there's this position called CRO, Chief Risk Officer. So many of these chief officer are actually, trained as an actuary. Again, just because of their knowledge, of their expertise in managing risk. In a fast-changing world with emerging risk and the need for more creative ways to tackle them, so there are always constant opportunities for personal and professional growth. Okay, so basically just saying that in terms of our opportunity, it's just unimaginable. So here just highlight some of the potential opportunity that most of our students or actuaries work. So obviously, traditionally, we have actuaries work in a life insurance company. We have, working in general insurance company or consulting firms. Okay, and progressively, that banks and investment firms are also beginning to hire our students as well, and hiring actuaries, and so are government agency. Right? Again, as risk is become more and more complex, and one of the function of the government agency is to regulate banks and regulate insurance company. And obviously, for government agency, who are regulating, insurance company, it will be desirable those regulator will have expertise in, as an actuary, so that they know exactly what are the risks, what are the characteristics of the risk profile that is facing the insurance business. And with the exercise program expanding in Indonesia, certainly someone who is expert, in exercise progressively also can find job, within university. And this is certainly true in other parts of the world, especially in Europe, in North America. For example, I myself is one of the academic actuaries. And another growing opportunity is that with the evolution of industry, the data analytic, the availability of big data, so this become more and more important. And because of our curriculum, our students also train, with a good knowledge in how to handling data. So data analytic company are also beginning to, pay attention to our students. So these are, really some of the potential opportunities. And it's important that for those who are interested in exercise is that we have to keep, a open-minded, have to have in mind that because of expertise, that we are not just serving the insurance industries, because risk is everywhere. So it's important to understand that, or remember that whenever there is risk, there are opportunities for us. In fact, one of the slogans that the Society of Actuaries has is sort of, perfect. Risk is opportunity. So again, I hope that you have this in mind and have a broader, mindset that whenever there is risk, there are opportunities for us. Especially, the world is really changing, for example, with the climate change, climate risk. So, progressively that, this is when an area that of interest to us as well, right? So to continue, I understand that, for most student that first begin to look at actuarial science, studies, it can be very overwhelming, and because it does entail that you know a lot of background material, and I'm going to discuss some of these in this presentation as well. But it's very useful to have at least why do actuarial science exist? Why do we need actuaries? So understand that I mentioned earlier that we are risk professional. We have lots of expertise in managing risk, but let's bring us back to our bread and butter employer or the operation under the insurance scheme. So typically in an insurance operation, in the simplest sense, we have two players, two stakeholders. On the right, there is an insurance company, and on the left, there are policy holders, right? So again, policy holders are concerned with some of the undesirable risk that he or she is facing. And hence, the policyholder is trying to find ways to transfer part or all of the risk to an insurance company, right? So by doing so, obviously, there is a cost to a policyholder, right? And again, of the type of insurance coverage, and that in turn can, depending on, let's say it could, or it could just be simply as a car insurance or a home insurance, or even some other catastrophic like earthquake or flood and so on, things like that, right? Okay. So, but essentially, it's very similar that the key is the policyholder is facing some risk, and he or she is interested in transferring some or all of this risk to an insurance company. An insurance company, on the other hand, receive the premium upfront, right? By receiving the premium, now the insurance company has a contractual obligation that in the event of a crisis or of a disaster or of a contingent event, then there will be a payout or so-called indemnity to the policyholder to compensate his or her losses, right? So again, this very simple diagram demonstrates that a typical insurance operation, how it works between policyholder and insurance company, and essentially it's just a contractual agreements between two parties, right? So think about what are the issues concerning policyholders. Well, first, the policyholder may want to, depending on the risk, the risk attitude, right? The risk profile of the policyholder, then he or she, will have to decide what kind of risk that the policyholder, wishes to transfer to the insurance company. And if a certain risk has been identified, another issue is, what type of policy, right? For example, let's say even though, if you have a car insurance, you also have to decide, for example, what will be the level of deductible, right? So typically in a car insurance, we can choose, what will be the deductible level. So again, that is a decision, obviously, will be depending on the risk attitude or the risk appetite of the policyholder. And connected with that, there's a premium, right? Obviously, from policyholder point of view, the cheaper the premium, the better it is, right? But typically, the premium will correlate highly with the insurance coverage, right? And fourth issue that concerns the policyholder is that given that this is a contractual agreement between two parties, and typically, insurance policyholder pay the premium upfront, and then expect to receive indemnity or compensation when there is an undesirable events, or contingency event happen in the future. So for example, in the case of life insurance policy, you typically pay, a regular premium over the years. And again, in God forbid, and when death occur, which could happen maybe, 40, 50 or 60 or 70 years later, right? So that your, beneficiary, your children could benefit from those death benefits. Obviously, a big issue concerning you, when you first purchase this insurance policy is that if you die in, let's say, 70 years from now, would the company still be there, right? Will the company still be solvent to meet those obligations, right? So obviously, you have to make sure that the company is not going bankrupt. So that would be the worst case situation, right? Because then you have to pay premium, for your whole life, only then to realize that, the company is not able to, pay the indemnity or pay the death benefit to your, children and so on, or surviving spouse, right? So what are the issues concerning insurer? Well, again, insurers playing the role of accepting risk. There are a number of issues that the insurance company also have to worry about. One is that whenever an insurance company launch a new insurance policy, the insurance company or the insurer also have to worry about the supply and demand, whether there is a demand from the policy holders, right? So this is where, it does require, actuaries to have a better understanding of the market, to have a better understanding of the human behavior, see what are of interest to policyholder, what type of product or what type of policy will be of interest to the individual or to the policyholders, right? And similarly, that premium, right? And again, from an insurance company point of view, the premium, cannot be set too low. After all, insurance company, is there to also make profits, right? But just like every other products, if we make the premium too high, and if it's not competitive, then there may not be any demand from policyholder. Or policyholder will prefer to choose insurance company B as opposed to, going with your company. Right? Third issue, again, when insurance company also have to worry about risk management. Why? When they receive all this premium upfront, insurance company do not just, do nothing. Do not just go to the beach and enjoy their life. Instead, the premium will be used to generate, or invest in a more, better return, opportunities, right? So in this aspect, the insurance company also have to manage the assets and the liability very, very carefully. Any potential mismatch, especially, any of the assets, whenever the assets is less than the liability, the company may have to go bankrupt. So one of the important role of an investment actuaries is how to manage those funds, right? How to ensure that, how to be responsible, ensuring that the company will still be around whenever there is claim arising, whether it's happening a year from today or 50 years from now or 70 years from now and so on. So the solvency or the sustainability of the insurance company is very, very important. Otherwise, it's going to create a huge impact to the society, right? Because after all, whenever an insurance company declares bankruptcy, it's the poor policyholder that will suffer the most. So these are sort of the typical operation, in terms of a insurance business. And to complicate this diagram a little bit, in the marketplace, there's also another type of company called reinsurance. So you can just think of this reinsurance as provide insurance for the insurance company. So in this aspect, the insurance company is like policyholder, and the reinsurance will act like an insurance company. So and the reason is that the insurance company, again, when they have this, underwritten many type of different line of businesses, insurance company themselves may be concerned that their risk exposure is too much, too high. So in that case, insurance company also interested in transferring or ceding some of the risk to a reinsurance company. Again, by doing that, it will cost the insurance company in the form of premium. And similarly, just like the role of an insurance company to policyholder, then the insurance company, again, by accepting the premium, so now the insurance company, the reinsurance company is responsible to pay any indemnity, depending on the experience, observed by the insurance company. Right? So this, again, diagram provides a snapshot of what's happening. And by understanding different role, how the business work, hopefully this will have a better idea of why we need, actuaries. Why do we study actuarial science? And in fact, the next slide is that by referring to what we just described earlier, right? We now talk about what knowledge do we need, right? And this gives you a better understanding about what kind of skill sets do we need to become, a proficient, as an actuary, right? Become a competent actuary. Well, first, dealing with cash flow at various time, because, the transaction that we talk about typically involving cash flows. And because of the cash flow are happening at a different time, a very important concept, in finance is called interest theory, or the time value of money. Basically saying that $1 10 years from now, are very different. They have different value. So which means we have to take into consideration, for example, the whether discounting or compounding, basically take interest into consideration. So this material is actually in the PRE exams, A10, financial mathematics. And of course, when we talk about risk modeling, risk management, and which means we have to have some way of modeling risk. And typically, from our point of view, we are interested not only qualitative, but also quantitative. And in terms of risk modeling, it obviously depends on the underlying characteristic of the risk that you're looking at. For example, if you're looking at a life insurance policy, then predominantly you're interested in the mortality of the individual or policyholder. If you are looking at a non-life, for example, you're looking at the car insurance, or you're looking at the home insurance, okay. So again, those are considered a general insurance type policy, and the way that we model risk will be a bit different as well, right? And similarly, if you're looking at, let's say, those catastrophic risk like earthquake, flooding, and so on, that happen only not frequently, but whenever it hits, the damages can be very severe, can be very, very high. So again, that also will require different tools in modeling, for example, typically involving using so-called EVT, extreme value theory, for example. So what we have here is that, again, if I were to do mapping onto the PRE exams, so, A60 will cover the material for the life modeling, and A70 will cover the non-life modeling, for example. And this slide also emphasizes that in addition to just simply do modeling, in order for the model to make sense, or to be of value to practice or to practical application, we also have to worry about the calibration, the parameter estimation to the empirical data. So this is where, statistics become very important, right? Because in statistics, there are a number of tools, there are a number of estimation methods that we can use in order to, validate, a proposed or a given model, right? And that material is predominantly in A50, right? And as mentioned earlier, one of the functions of the insurance company is, in addition to designing insurance policy, managing risk on behalf of the policy holder, and a big part of the insurance company also involved in investments, right? As mentioned earlier, that the insurance company receives the upfront premium, and those premiums are not just sitting in the bank doing nothing. And those premiums will be used to invest in the more profitable investment opportunities. And this is where, again, as an investment actuaries of the company, then you also have to be very careful of how to manage your investment risk, right? So again, the last thing you want is to have a bad investments, so that the value or the asset of the company, depletes or drop significantly. And that related to that, so there's important concept related to asset liability management, right? And solvency or reserving, right? So again, these two material basically cover in the fellowship exams, F10 and F20, all right? And of course, there are some other, topics which are important as well. For example, the accounting A40. So that again allows you to have a better understanding of the financial statements, right? And the balance sheet and so on. And of course, economics is always very important, for you to understand the supply and demand, and how the market, work and so on. And what is less discussed, in most actuarial curriculum is the economic of risk sharing, right? So for example, if you look at here, this diagram again, even though this is just a simple insurance operation where risk is transferred from a policyholder to insurance company, or some of risk is transferred from insurance company to reinsurance company, we can take one step backward and ask ourselves, why would the policyholder interested in the insurance to begin with? Or why, is the insurance company interested in issuing an insurance policy? What is the economic behind? Can you formally justify, essentially this is some kind of risk sharing, right? So can you formally justify that, as a whole, the entire economy or entire society will benefit from this so-called risk transfer or risk sharing? And in fact, these topics belong to so-called insurance economics. And this is another fascinating theory or fascinating result, that indeed you can show that by appropriate risk sharing, you can show that the entire society or the entire economy will actually be better off, right? And also, optimization, while it's not explicit here, optimization is actually implicitly in any of these studies, right? For example, we talk about, what about optimal insurance policy? As I mentioned earlier, let's say for a driver point of view, right? You just bought a brand new car. So does it exist an optimal deductible, right? And similarly, from a insurance company point of view, do they have any better, more innovative insurance solution to cover certain risks? For example, in view of the pandemic risk, or in view of the flooding or earthquake, or disaster finance and so on, is there a better solution? Can we optimize somewhat? And also the mention about the AIM, which is an important role of an insurance company. So is that an optimal, AIM strategy? And similarly, that, mentioned that the company able to transfer some of the risk to a reinsurance company. Does it exist an optimal reinsurance strategy? So while in practice, the company may not go into very details or use heavy mathematics in doing this kind of optimization, but academically, it certainly provides opportunity for us as a researcher, as an educator, to push the boundary and talking about different ways of how to, optimize, or increase the efficiency of an insurance, company or insurance operation and so on. Right? And finally, again, mention about the data analytics. Again, with the abundance of big data these days, how we have to again improve ourselves. We have to be more progressive and how to make use of this big data and improve our underwriting or improve our risk management solution and so on. And finally, just remind that, again, the insurance business is it's a business, right? It's here to make money somewhat as well, in addition to provide the protection coverage to policyholder. So a good understanding of the business acumen, business savvy is also important. So this shows that in order to become an expert, in risk management, or in order to become a qualified actuary, this slide shows that we do have to be very well-rounded, right? Not just focus in mathematics. We do have to know many different, part of the, curriculum, right? And each and every single of them play a very important role in, contributing us or in developing us to become a even more competent actuaries. And it is this so-called very diverse, multidiscipline that many students find it very challenging, because that, you're just not only need to know, mathematics, you also need to know corporate finance. You also need to know financial engineering. You also need to know economics, for example, right? So for the remaining of the presentation, again, I will provide, these are the following subtopics that I will talk about very briefly. So for example, from a risk model point of view, I will talk about, provide a very simple life insurance application and talk about the life insurance benefits and how to determine premium, for example. And then actually talk about the demand for insurance, right? And then aggregate risk modeling and risk measure to close up. Again, because of the time issue, each of these topics I will only cover at a very superficial, very high level. We're not going into any specific details, and I assume that the rest of the lecturer will provide you with more details explanation. Again, it's important that in studying actuarial science, it is important to constantly relate theory to practical application. The A not only stands for actuarial, but it also stands for applied. So it's very important that to constantly relate theory to practice. After all, actuarial science discipline is motivated by risk surrounding our day-to-day life. Right? And in my view, actuarial mathematics is not abstract. In fact, it is very intuitive, with many results that can be interpreted easily. So I do encourage that as a newcomer, when you get acquainted with actuarial mathematics, making sure that do not just memorize the formula blindly, right? Make sure that you do understand what they really represents, and more importantly, whether you could interpret them verbally or explain to a actuarial, specialist, right? Because in many of the formula or many of the results that we have is actually very intuitive. And this is what I actually passionate about actuarial science, in a sense that, I, constantly able to relate, the theory to practice. And by doing that, this also enhances my interest and my learning in actuarial science as well. And this is something that I always encourage my students to do as well. So for risk modeling, so why do we care about risk modeling? Certainly, again, in order, our interest is to quantify, to measure, right? Because without quantifying, without measuring, we will be very difficult to do any management, right? And if you do have a proper model, then this also facilitates us in pricing the risk itself, right? And this is obviously a very fundamental step in our line of work. And the choice of model obviously depends highly on the characteristic of the underlying risk, right? For example, whether this is a short-term or a long-term risk, or whether this is a risk with a short tail or risk with a heavy tail, for example, right? So in this aspect, the modeling or the choice of model will be very different as well. And this is also why I mentioned earlier that, whatever model that you use, it's important that to have the model validated or, based on the empirical data. And this is where, statistics, become very important, very useful then. So for life insurance application, so again, let's look at a very simple case. Like I say, I'm not going to go into any details, but rather superficial level, right? Okay. So for life insurance policy, the underlying risk obviously is the policyholder mortality, right? And typically what we do is that we define this Tx as a random variable that is used to model the future lifetime of a life age X. So that Tx plus X represent the age at death for life age X. Again, very intuitive, right? So because this is how the Tx is being defined as the future lifetime for an individual, whose age is X. And CDF, so again, we can just define CDF as follow, and this is known as lifetime distribution Y. So because the CDF here, because Tx here is a future lifetime random variable, and since the CDF is calculating the probability that the Tx is less than or equal to T, so which means that this gives you the probability of someone who is age X will not, will die within the next T years, right? So again, this is the type of interpretation that I'm looking at, right? Rather than see this as a traditional, as a standard CDF. But it's important to interpret that. What does it mean in real life, right? What does it mean in practice, right? And similarly, that, you can also define the survival distribution or survival function. So simply 1 minus the CDF. So that obviously means that, the probability, someone who's age X will survive more than T years, right? If you were to, again, verbally interpret that survival function. And by definition, then T0 simply refers to the future lifetime of a newborn, right? Is someone just, just newborn. And hence, if you take the expected value, and this is what we typically heard about life expectancy of a newborn, right? And note again their interpretation. In actuarial, curriculum or the actuarial mathematics, so there are obviously a number of distributions has been postulated for modeling future lifetime. So Compass law and Markham's law are two of the more popular one, right? And again, I'm not going to go into details, but rather just want to show to you that, for example, this is actually a survival distribution, for from a Compass law. And this is for life age 20, 50, and 80. So now, by looking at the survival distribution, and one of the curve belongs to someone who is age 20, and the other curve belongs to someone who is age 50 and age 80. So now think about this, and which of this is for age 20, age 50, and age 80 then? Well, one way to see that is, imagine that if you draw, let's say if you, put a vertical line at, let's say t equal to 10, right? So again, imagine that you put a vertical line at t equal to 10, right? So then what do you see here, right? The in terms of the so if you put a line like vertical 10 here, right? So you see that the topmost curve will have a higher probability or higher survival probability, right? As compared to the bottommost curve. So this must mean that, again, comparing to age 20 and age 80, so the probability of you surviving another 10 years obviously will be higher compared to someone who is age 80. So in this aspect, it's not surprising that the topmost curve will belong to someone who is age 20, and the bottommost is age 80, and age 50, for example, for the middle one. Right? And similarly, that if you're looking at the PDF, so you get something very similar as well. And note that, for example, someone who's age 20, for example, the mode, right, is around t equal to 60 in this case. So which means that, average people die is age 80, right? And similarly, if you are age 50 already, then the mode is around t equal to 30. Again, consistent that, this is the age where most people die around this age. And this is a curve PDF for someone who's already 80. So in this case, it would drop significantly, after that. And this graph showed the US 2002 mortality rates by comparing males and female. So first of all, it actually provides some interesting phenomenon about the mortality rate for male and female. So first of all, the rates for male is much higher, right? As we all know, right? The mortality rate for male is actually much higher, right? And another observation is, as you can see, at the infant age, right? For a newborn, the mortality from the curve is actually very high, but it does, decrease significantly, as you get older, right? So in this case here, that's the, there is a, and then eventually, it dropped around 10 and so on. And the mortality start increasing until around age 20, where we see a bit of hump, for example, and then increase more or less linearly, right, thereafter. So internal modeling, certainly this, because of this peculiar behavior, so modeling can be quite challenging. And of course, it does mention that, it does confirm that for high ages, let's say, over 35 or over 40, it will be a lot easier to model because it seems to grow linearly, right? And it's the early part that's much harder to fit for a given distribution, right? Or given curve. Another worth mentioning is that with the advances in medical and so on, we are also observing people are living longer, right? We have have a higher longevity. And internal modeling, this also present another challenge in the sense that in the sense of high age mortality, because by definition, at higher ages, the number of survivors tend to be very, very small, right? And hence there is an issue with data scarcity, and not to mention is data credibility, because at high ages, let's say looking at 105, 110, 120, so there may be a lot of misreporting, right? And it could just simply be, a honor mistake. So that also provide, a challenge then. While this mortality curve, is a sort of more like a population, let me also take the opportunity to emphasize that insurance companies are not interested in the lifetime distribution of the general population. Why? In fact, they are more interested in the insured life. Right? Because think about the insurance is issued to policy holders, right? Not everyone has insurance coverage. And not every insurance company have the same experience. So in practice, what companies do is they have their own house mortality experience based on their past historical record and based on the kind of policy holder that they have been insuring. And based on this information, what they do is typically they will build their in-house mortality table and use those experience in mortality modeling and pricing insurance policy, right? So typically those, in-house mortality experience will be a bit different compared to the general population. Again, something for you to keep in mind that, right? What about the life insurance benefits? Well, here, in order to understand the insurance benefits, there are basically three components. One is the underlying assumption on the lifetime distribution, which we have briefly described. Second is the timing, right? So again, when it comes to the benefit payments, in most cases, we do not know the timing of those payments, and which means that we do have to take into consideration, when the payment will be made, and also the so-called time value of money, right? Especially in some policy like life insurance policy, $1 million could be paid, 50, 70 years from now. So which means that the interest rate, the time value become very, very important. So supposedly that if I let the notation VT be the present value of $1 paid in year T, if delta, is the deterministic interest rate compounded continuously, then VT is just simply equal to e to the power minus delta T. Again, of course, if the rate has been coded on a discrete compounding, the formula will be a bit different, but for simplicity, let's consider continuous case. So in particular, if $100 is paid in year 5 and 6% compounded continuously rates, then its present value is simply equal to 100 times e to the power minus 0.06 times 5, which means 74.0818. So which means that, assuming 6% interest rate, right? $100 in year 5 years from now is equivalent to $74.08 as of today, right? Again, the difference in value is due to the time value of money, right? And in terms of insurance policy, so again, let BT be the benefit function of an insurance policy. And obviously, BT will be a function of the future lifetime and also a function of what kind of insurance policy that you're looking at. For example, if you look at the whole life insurance policy, which pay, let's say, $1 at the moment of death, so then which means that the BTX will be equal to 1. Or if you look at term insurance, which is another popular insurance as well, that pay $1, let's say, at the moment of death, provided death occur within the first M years. So if that's the case, then the then $1 would pay provided that TX is less than or equal to M, and nothing if TX is greater than M. So obviously, when we use the term or the inequality, say condition that TX is less than or equal to M, intuitively, what this means is that death occur less than M years, right? If TX is greater than M, again, if you were to interpret this, It simply means that death occur after M years. All right. So again, it's important to always content relate, how to explain those rather than just looking at the formula, right? Looking at the condition without understanding that in practice, what does it mean? So with this VT notation, VT and BT being defined, right? Then we can also define another random variable called Z, which is the present value of a dollar insurance benefit random variable, right? So, or simply just the products of B and V, right? And note that here, in terms of discounting, unlike in the previous case where I know exactly 5 years, in this case, there is a uncertainty. It's contingent on death actually happening, right? And the timing of death obviously is unknown to begin with. So, but in any case, notationally, it's just simply the product of the two. So based on this random variable Z, which is the present value of a dollar insurance benefit random variable, then now we can do a lot more now. For example, we are interested in, let's say, its expected value. So if you were to compute its expected value, then this is just the expected benefit from the insurer point of view. Or from the insurer point of view, this becomes the expected payouts or the indemnity. And sometimes we also refer this as EPV, expected present value, or APV, actuarial present value. In addition to mean, we can also look at the variance, right? So that will give us some variability, some understanding of the variability of the insurance benefits. And of course, other than mean and variance, we can also look at other stochastic properties such as different quantile or different risk measure that we're going to look at shortly. And what about the insurance premium? Like, how do we compute? How do we calculate insurance premium? So to do that, again, it's customary to define this so-called L0, which is a loss random variable to an insurer. And that is just simply the present value of the benefit outgo minus the present value of premium income. So again, it's very intuitive because if you think about L is the loss random variable to an insurance company, right? The losses will be defined is how much I have to pay out compared to how much I have received. So under the equivalent premium principle, it simply means, and note that, okay, so before I do that is the PV of the premium income, obviously it will be a function of P, right? So under the equivalent premium principle, then basically it says that, we just assume on average, the expected value of L0 is equal to 0, or in other words, the expected, present value of benefit outgo equal to the expected present value of a premium income. So this implies therefore a given policy, future lifetime distribution, interest rate assumption, premium structure, whether it's a single premium or is a regular premiums, regular payments. The insurance premium P can be determined by solving above equation, right? Again, recall that the PV of premium income will be a function of P, right? So again, it seems to be very intuitive that you're equating the expected present value of outgo to the expected value of the premium that you received, right? So another insurance premium principle that we will look at is portfolio percentile premium principle. Again, this is also a bit more realistic. Basically, it assumes that there is a large portfolio of identical and independent policies. So identical, which means that policy have the same premium, benefit, and term, and the policyholder are subject to the same survival model, and so on. Independent, again, a very common assumption in our study is that policies are independent of each other with respect to mortality. So if we assume that N is the number of total policies and L0I is the future loss random variable of the I's policy, and if L represents the total future losses, then basically this is what we have, right? L is just simply the summation of all these individual losses. And from here, we can determine the mean and variance accordingly, right? As shown here, okay? So given that we have the first two movements, right? Then the premium P under the portfolio percentile premium principle is determined such that it satisfies these, probabilistic statements. What this says here is that the probability of L less than 0, is actually equal to alpha for alpha close to 1. Again, think about whether this makes sense, whether this is reasonable or intuitive. What does the probability of L less than 0 mean? Since L is a measure of losses to the insurance company, if it's positive, which means there is a positive losses. If it's negative, which means it's profits, right? So which means with alpha is a value which is very close to 1. So this means is that you want to determine the premium P such that with a very high probability, the company will have a positive profit from this insurance business, right? So again, it makes sense, right? Very intuitive, nothing really fancy, right? So to continue on how to get the premium P, so this is where the central limit theorem become very useful. So then you can go through these simple mathematics by using the standard normalization, right, in order to obtain that and then determine P by solving this equation, right? So again, the expected value of L and the variance of L will be a function of P, right? So again, this provides a very simple and also rather intuitive way and seems to make sense as well, right? So certainly, from an insurance company point of view, you want to charge a premium so that you have a high chance of having, a profit situation. What about the demand for insurance? So again, this is an interesting discussion in a sense that, how do we ensure that the insurance company, when they create a new product, there will be demand from policyholder point of view. Especially in many cases, the insurance premium is set higher than the expected insurance benefits, right? So again, first of all, why do a company typically set a premium which is higher than the expected payouts or the expected benefits? If premium is set exactly equal to each other, obviously then that is a break even, right? But think about from an insurance company point of view, there are some other expenses that they have to worry about. Actuaries are expensive. Someone have to pay their bill, right? And they also administration costs, right? And company also have to make profits. So typically the insurance premium will be higher than the expected payouts or the expected losses. So then the question is, will a policyholder still willing to pay for an insurance coverage even if the premium is higher than the expected benefits? So interestingly, the answer is yes. And this can be justified using the so-called expected utility theory that assumes policyholders are risk averse, right? By risk averse, then we means an individual is actually dislike risk, right? So an individual would not be involved in gambling, for example, right? Someone who loves gambling is actually, is known as risk seeker, right? So to do this, let U be a function, is a utility of wealth that transforms dollar value into utility value. So think about W is a wealth, or in dollar value. So what this function does, what this function say is it's just a transformation from a dollar value into a equivalent utility value. And when an individual is faced with uncertainty, expected utility theory asserts that the individual is concerned with gain and losses from utility as opposed to the dollar value itself. So which means that, if you are an expected utility individual, you actually look at the gain or losses from the utility value rather than from the dollar value. Or in the context of insurance, the expected utility theory states that an individual will buy insurance when the following condition is satisfied. The expected on the left-hand side says that is the expected utility with insurance is higher than the expected utility without insurance. So basically, you are looking at someone who want to have as high a utility or as high an expected utility as possible. So again, when you make a decision, right, whether to have insurance or no insurance, what this EU theory, expected utility theory, say is that all you have to do is to compare their expected utility under two scenarios. One is with insurance and one is without insurance. If you realize that if the expected utility with insurance is higher than the expected utility without insurance, then you should have the. Otherwise, you better not to buy insurance. So to make this concept more concrete, I have a very simple example, of course, naive example, where a decision maker with an initial wealth of 10,000 is facing a loss of 3,600 with 10% probability and zero otherwise. What is the maximum premium he is willing to pay to completely insure against such loss if his utility of wealth is given by this so-called square root function? Again, a very simple binary outcome. So what we can do first is look at the potential losses, right? So we have, the losses is either 0 or 3,600, 0 with 0.9 probability, 3,600 with 0.1 probability. And from here, we can compute the expected losses, right? Which is just simply 360. And what will be the possible wealth if there is no insurance? Well, then again, we can look at two scenarios as well. So here I have the subscript NO to emphasize that this is no insurance case. So if there's no insurance, then which means that you are willing to take the risk and expose to the potential losses. Then with 90% chance that your wealth will not be affected, but with 10% chance your wealth will decrease from 10,000 to 6,400 because of the losses of incurred loss of 3,600. And if that's the case, what will be the expected utility of wealth with no insurance? So it would just be, taking the expectation, right? And you can just verify that this is indeed equal to 98 in this case. That will be the expected utility value. And what about wealth after paying P for full insurance? Again, assuming that this insurance contract charges P dollar. So, and by having this insurance, they will reimburse entire loss to you. So if that's the case, then by paying P dollar, your wealth with insurance is just simply 10,000 minus P. Again, see whether this makes sense. Because by paying P dollar, now you have a peace of mind. There's no longer any uncertainty in your wealth level. By willing to pay P dollar upfront, then you have removed the uncertainty, because when the loss does occur, you know that it will be fully reimbursed by the insurance company. So hence, your wealth level will become a deterministic function, will be certain, equal to 10,000 minus P. And hence your expected wealth with insurance is just simply square root of 10,000 minus P. Right? So now you have two situations. If you were to go with the insurance, then your expected utility is square root of 10,000 minus P. Without insurance, your expected utility is 98. So in this case here, you can then define the maximum premium P star by equating the two of them. As long as 6, the decision maker. So verify your maximum premium P star is actually larger than 360, which is the expected loss, right? So more than expected loss in order to have the peace of mind. If the premium happen to be 370, obviously is less than the P star, which is 396, then obviously you will accept the insurance proposal. But to be certain, also compute that, in this case, your expected utility in this case with insurance is 98.13, right? So which is higher than without insurance, which is 98, right? Again, this confirm or validate that indeed you will have the insurance if it's charged 370. In fact, using under the insurance economic procedure, you losses. And mathematically, if someone is risk averse, provided that these two conditions increasing and the second derivative is decreasing. All right. Unlike the life insurance claim, typically we only deal with a single claim, right? Because we are typically dealing with the contingent event of life or of death. The insurance such as car insurance or health insurance, typically we deal with a multiple claims. So for example, over a 1 year, there could be a multiple car accidents, and there could be a multiple visit to hospital and so on. So in this case, we do have to modify our modeling approach by using a so-called collective risk model, right, which is given as follows. So where in this case here, X represents the random variable representing the amount of ith claim, right? So this measures the severity or the magnitude of the claim for the ith claim. So because of focus, this one is to model the severity and the other is to model the frequency separately and then coupling them. A more frequent model, and by studying them separately, right? Okay, and our objective is to determine S, which is the aggregate distribution. It will go into details on different aggregate either via convolution or analytic or recursive or some inversion method, or even some approximation when the exact solution is not possible, right? Again, the mathematics will be depending on which method they look at. Just for our purpose, I would in this here, our task is to find the random sum. So again, recall that n is a random variable and hence it's called random sum. So to compute the CDF, so this is exactly what we have here. Again, this is follow a very standard. At the end, what we have here, right? So as in this case is called compound distribution, where the F star n is the known as the n-fold convolution. So again, it's a bit complicated, right? Okay. So risk measure. Suppose we have a loss random variable L, and of course the ability is one of the fundamental role of actuaries, right? As again, a theme that I've emphasized many, many times. A risk measure is simply a real value mapping or function of L. And here let's denote as rho, arising from the risk. So it is attempts to provide a single number summarizing the risk represented by L. So in these aspects, you are a risk measure that you're familiar is variance, for example, right? Again, variance gives you some idea about the variability. In some sense, it also considered as some form of risk measure. But because from a risk management point of view, right, variance is a measure of variability around the mean. But in many cases, we tend to be interested in the extreme events, right? So which means that, and when we talk about risk measure, we typically think about how to quantify the tail behavior, right? Or the right tail distribution of a loss distribution. Well, one obviously is the internal risk management tool, right? So used internally to quantify risk exposure for each line of business, or even setting risk limits for each trader that the company, or for example, the regulator may require you to set aside a certain reserve or set aside certain regulatory risk capital, or even define this kind of regulatory risk capital. It may be based on some function of a chosen or prescribed risk measure, for example, right? And another use is calculation of insurance premium, for example, right? Okay, so it can be used to price insurance risk. And there are other applications. Here, I will just name two potential applications. For example, SRV in 2002, they actually measure and to facilitate the construction of optimal portfolio, right? And this has become a very important application. Another paper work that I've done, a number of years ago is actually how to exploit this kind of risk measure into deriving an optimal form. And some popular risk measure, again, here are some variance and semi-variance, which will be should be very familiar to many of you. But what is not so familiar is, for example, value at risk, also known as quantile risk measure. So for simplicity, that we assume that for a continuous random variable with strict increasing function CTF, value at risk at alpha level confidence is simply given by this, right? So what this means is that, think about alpha is some value which is close to 1. Let's say it's 99%. So what this means is that the value at risk of a particular risk or a particular portfolio, supposedly that at alpha equal to 99%, if the reported VAR is 1 million. What this means is the probability of loss less than or equal to 1 million, that will happen with 99% confidence. Or in other words, the probability of having an extreme loss greater than 1 million, that will only occur with a very small probability of 1%, right? So now you can see that this is what I mean by the quantile risk measure. And again, it's very intuitive. The other risk measure is called conditional tail expectation, or CTE, or sometimes also called tail VAR or CVAR, conditional VAR, or expected shortfall. And for continuous loss distribution, this is how it's been defined formally. All right. So and what this means is that it captured the on average what would be the losses given that loss exceed VAR. Right. So note that even though I've shown these two definitions, so this definition again assume that the random variable is continuous and strictly increasing CTF. There exists a more general definition for these two risk measures. So graphically, this is what is being shown here. Hopefully this provides a contrast between the difference between VAR and CTE. So obviously from here, you can see that Y VAR is a quantile, right? And whereas CTE is a calculating the average, to the right of VAR, okay, right? Sort of looking at the average size of these losses. And this also highlights a potential issue with value at risk. While value at risk gives you a probabilistic because it's a quantile, it actually, just like my earlier example, there is a 1% chance that the loss will be greater than $1 million. But it does not give us any information is what would be the expected exposure or expected loss, or if the VAR actually happened. This may be very important depending on the underlying risk, whether it's a short tail or if it's a long tail, right? As you know that if it's a heavy tail, then, given that VAR has hits, the actual losses can be very large compared to a distribution with a short tail, right? And this is also the reason why, CTE or the expected shortfall, is becoming progressively more and more popular compared to value at risk. Another important reason why CTE is more popular is that, related to this so-called, what are the criteria for a good risk measure, right? So what properties should a good risk measure possess? Let X and Y be any two risks. For example, the translation invariance means that, for a rho, the value, the risk measure of X plus C is equal to risk measure of X plus C itself. So this property is important, especially in the context of solvency or the risk capital. So think about in practice, why regulator require banks or insurance company, especially insurance company, to set aside some kind of risk capital, right? The reason is if you set aside this risk capital, you can decrease your overall level of risk. And as is shown here then, right? For example, let's say supposedly without this additional risk capital, your rho X is calculated to be, let's say, 10 million. And suppose C, suppose the regulator required to set aside C equal to 4 million, right? So the C will be minus 4 million. And what this means is that when you look at the risk measure of the combined portfolio with the original risk and your risk capital, then the amounts will be reduced proportionally by the size of your risk capital, right? And that's probably called translation invariance. Monotonicity. So basically what it says here, if the probability of X is less than or equal to Y, so in other words, if you know that in always cases, Y is riskier than X, intuitively, then the risk measure on Y should also be higher than risk measure on X. Again, very reasonable, monotonicity. And positive homogeneity simply means that, again, this application, think about this, an important application of this is supposedly that, think about when you do risk management using different currency. What this property ensure that regardless of whether you analyze the risk using rupiah or using Sing dollar or Canadian dollar, as long as the exchange rate is constant, whether your overall risk will be independent of the currency, right? They should give you the same results, well, when converted appropriately, right? So that you cannot arbitrage, you cannot cheat by using a different currencies, right? Finally, the sub-additivity simply says that, if you look at the risk measure of a portfolio of 2 risks, it should be less than or equal to the portfolio of the individual risk measure. So any risk measure that satisfies these 4 properties is known to be coherent. And interestingly, that's the CTE satisfies this coherent property, but not value at risk. The importance of sub-additivity, again, among the 4 conditions, sub-additivity is the most challenging one. Recall for any 2 random variables or 2 losses, X and Y, this is what we meant by sub-additivity. So why is this important and why does it make sense? Well, it makes sense because we believe that there is a diversification benefit, right? There is a incentive to pool risk together, right? Because of the correlation, so there should be some benefit from diversification. Just like when we invest in stock, it's also advised that we should not just invest in do not put all our eggs in one basket, right? And based on the concept that merger does not create extra risk. So this also creates some interesting phenomenon that what is the implication if a regulator uses a non-sub-additive risk measure to determine regulatory capital requirement for a financial institution? Similarly, what if a bank or an investment firm uses a non-sub-additive risk measure to determine risk limits for the trader? So in the first case, what this means is that there's an incentive for a company to divide into many subsidiaries or split the company as many as possible. Because if the risk measure does not satisfy the sub-additivity, then the sum of the individual smaller company, right, will be smaller than the company in aggregates, right? So it will encourage this kind of behavior. And of course, in practice, it may be rather difficult to implement. And similarly, from a trader point of view, right? So then there's an incentive to measure risk on a separate different portfolio rather than combine all these investments together, right? In order to exploit these non-sub-additivity properties. So again, as I mentioned earlier, CTE is coherence, but not VAR, except in some special case where, for example, if the risk is elliptical distribution. So this table just shows to you, again, the importance of tail behavior. So for example, where I look at the different alpha level, and this compute the VAR for a different normal or T distribution for 4 degrees of freedom, and this look at the ratio and look at their proportion, all right? But what is more interesting is this example here, where here we assume that the losses for the next year are estimated to be 100 million, with standard deviation of 223.6 million. And by calibrating to the normal Pareto and Weibull distribution, and we're asked to determine the VAR and CTE in this case. So again, we basically using the moment matching idea to calibrate the model so that these are the respective parameters. And this is the results here. Again, in view of time, let me just emphasize that and look at the differences here. If you assume a normal, let's say a very high, alpha, from a normal distribution, if you assume that the risk has been normal, the losses is only 852. But if you assume Pareto, or Waibu, the expected shortfall or the CTU can be as high as 3,800, right, or 3,200. Note that in these two cases, it does indicate that the importance of tail distribution. If you have, for example, mistakenly believe that these losses is actually a short tail, right, then you would have severely underestimate losses, right, or underestimate the risk, right? If the underlying distribution is truly Pareto compared to your estimate based on normal, which is 800. So again, this call for a concern, especially when you deal with extreme risk. You have to pay extra attention to tail behavior. So this basically conclude my presentation. And again, I thought I would just leave with you is some of the keywords, some of the buzzwords that we have to know, especially when you start studying actuarial science. So keep in mind all these buzzwords. All right. So I think again, thank you very much for your attention. And this is what I've installed for this overview. And thank you again for the opportunity to speak to all of you. And it has been my great honor to do so. Thank you. Okay.